Welcome back to the deep dive. So, if you're trying to navigate the Texas commercial real estate market right now, you know how overwhelming it can be. You're probably just drowning in spreadsheets and zoning codes.
Oh, absolutely. It's a lot to sift through.
Well, today we're going to give you a shortcut. We are doing a very focused deep dive into a curated list of opportunities from the Eureka Business Group, or EBG. It's dated December 13th, 2025.
Right.
Our mission here is to basically filter this data for you, decode the investment logic, and show you where the real value and upside might be hiding right now in DFW and, the broader Texas market.
And this is a great source to use for this kind of analysis. EBG, they're not generalists. They've been around since 2008, and they are deep in the retail commercial space, especially in Dallas-Fort Worth.
So they know the landscape.
They really do. They guide everyone from individual retail investors all the way up to major franchisees. They handle investment sales, representation for landlords and tenants, consulting, the whole package.
And their timing seems really intentional here. The notes with these listings, they really hammer this point about year-end tax savings and getting portfolios optimized for 2026.
Exactly. They're positioning their clients for what's next. And it's interesting, they're not just aiming at the big players.
What do you mean?
Well, they've included a video resource that breaks down the entire transaction timeline, specifically for first-time commercial buyers.
Oh, that's smart. So they're trying to bring new people into the fold, not just serve the seasoned pros. We'll try to do the same here and, explain our terms as we go.
That's good.
Okay, let's unpack this list. We'll start with what EBG is calling their bite-size opportunities. These are all deals under the $2 million mark.
Right. And this is typically where you find investors looking for flexibility, maybe for their own business, or a quick way to deploy some capital.
Or a value-add play.
Exactly. It's about active management. And you'll notice owner financing pops up a lot in this category for that very reason. It just helps get the deal done.
All right, first up, a medical or office space in McKinney. It's about 2,900 square feet, listed as 2 combined units. What's the immediate advantage of that setup?
It's all about risk mitigation. An owner could, use one unit for their own practice and then lease out the other one. Instant cash flow.
Or an investor could just split it between 2 smaller tenants.
Yep, diversifies the income. But the real kicker here, the thing that makes you look twice, is the price. The listing says it's selling well below the county assessed value.
Okay, let's pause there. Below assessed value. What does that practically mean for a buyer walking in the door?
It means you have a built-in equity cushion from the moment you close. The county itself thinks it's worth more. And in a market like McKinney that's appreciating, that's a huge safety net.
Plus, your property taxes are based on that lower value, right?
That's the immediate savings right there. And with owner financing on the table, it just makes the whole transaction that much smoother.
Okay, moving on to Louisville. We have a flex condo, 2,607 square feet. The listing calls it a modern flex product.
And it is. This is a perfect solution for a small or medium-sized business. It has a mezzanine level, which is great for extra office space or storage, and it's 100% HVAC throughout.
Which is not standard for a warehouse space.
Not at all. That's a key detail. It means you can store sensitive inventory, or you can comfortably run an office out of there. It's a big differentiator. And its location. It's all about logistics.
Yeah, they highlight the access to SH 121 I-35.
And the Dallas North Tollway, the DNT. That's critical. It connects you to all those affluent northern suburbs, and you're right near the huge Grandscape development. So it's a bite-sized investment, but it comes with truly premium access.
Okay, now for something completely different. A self-storage facility in Azle, 18,100 square feet, 109 units, brand new.
And here's the most important detail, the one that defines the entire deal. It's listed as vacant.
100% vacant. That's a huge risk. You're covering all the costs from day one with zero income.
The risk is high, no doubt. But the potential reward is just as high. You have immediate lease-up upside. An investor gets to set their own rates from scratch.
So you're not stuck with old, below-market leases.
Exactly. You control the pricing strategy from day one. And Azle is a strong market for this kind of product. It's got great access to Highway 199 and the I-35 corridor.
Yeah.
For the right operator who can execute a fast lease-up, it's a fantastic value-add play.
That's a perfect contrast to the last deal in this bracket, a retail strip in Irving, 6,113 square feet.
This is your pure cash flow play. It's 100% leased, so the vacancy problem we just talked about, gone.
Solved.
And it's priced below replacement cost.
Meaning you couldn't build it from scratch for this price today.
Not even close. And the cap rate they're offering, 7.75%, is really strong for a fully occupied retail center in DFW right now. The viability here is all driven by traffic. It's at an intersection that sees more than 44,800 vehicles per day.
So constant eyeballs on your tenants. For a passive investor, that's a really stable, reliable choice.
For sure. So that's sub $2 million bracket, really hit on immediate income and, accessible value. Now we're shifting gears pretty dramatically.
Right. We're moving into assets where the return is tied to something very different.
It's tied to future growth, to population trends, and honestly to the local planning commission. We're talking about land and development opportunities.
And looking at the list, Mesquite and Cedar Hill seem to be the focus for EBG's land strategy.
They are. Let's start with Mesquite. It's a 2.2-acre parcel of mixed-use land.
A classic development play.
It is. It's a corridor redevelopment bet. It's got 320 feet of frontage on Gus Thomason Road, and it's already zoned for mixed use. That's a huge head start.
So what does that zoning allow for?
The potential is for up to 84 apartments, plus some ground floor retail. But the most critical piece of information here is that the city of Mesquite is actively supporting redevelopment along this corridor.
That's a political tailwind. It de-risks the whole approval process.
Massively. You're not fighting City Hall, you're working with them.
Okay, that brings us to Cedar Hill. It looks like ground zero for their land strategy with three really distinct options.
Yes, and to understand them, you have to understand the zoning. First up, the big one. Almost 38 acres, zoned residential.
So a straightforward housing development.
Pretty much. It's a large-scale, predictable play. It's an asset sale from the Cedar Hill School District, CHISD, so it's likely a sealed bid process. This is going to attract the big home builders.
Then things get more interesting. There are two separate 15-acre parcels, both zoned SFE. First, what is SFE?
SFE is single-family estate, so think very low density, large lots, big houses.
But these two parcels are presented as completely different strategies, even with the same size and zoning. Why?
It all comes down to context, location. Option A is right next to a high school and a middle school.
Okay.
So even though it's zoned SFE, its highest and best use is probably a straightforward subdivision. The demand is built in. Families want to live near the schools. It's the safe bet.
And option B?
Option B is the aggressive, speculative play. It's also SFE, but it's on Beltline Road, right next to existing commercial properties.
So the investor here isn't planning to build mansions.
Not at all. They're betting on a rezone. They're going to argue that because they're surrounded by commercial, this parcel should be rezoned for something more intense, like retail or multifamily.
So you're buying an option on the city's future vision for that road. Much higher risk.
Much higher risk, but if that rezone gets approved, the reward is potentially exponential compared to the safe subdivision play.
Got it. And the last one in Cedar Hill is a 5.5-acre property, already has a building on it, zoned OT Res, Old Town Residential.
Right, and this one is located in what EBG calls the heart of Cedar Hill's future growth path. That OT Res zoning is designed to be flexible. It encourages density, vertical development.
So what's the play here?
It's prime for multifamily, build-to-rent communities, townhomes, maybe mixed use. The investor can pivot to whatever the market demands without waiting years for a zoning change. The flexibility is the value.
Okay, here's where it gets really strategic. We're stepping up into that $2 to $5 million bracket. And the focus here shifts completely. We're talking about stable, high-quality, tenant-backed assets. This is where investors pay a premium for predictability.
That's exactly right. This is for the investor who wants passive, predictable income. They're looking for secure leases in high-growth areas where they know they'll have customers for the long haul. Minimal headaches.
First on this list is a retail strip in Gunter, about 9,100 square feet, 100% leased.
The stability here is layered. First, Gunter, up on Preston Road, is a high-growth, high-income area. Second, you have to look at the tenant mix.
What's in there?
Dental, orthopedic care, and a restaurant. These are essential needs-based services.
Things people can't buy on Amazon.
Exactly. They're resistant to e-commerce and economic downturns. You're not buying a fad, you're buying a piece of the local community's essential infrastructure.
And then we see the single-tenant net lease strategy come in strong. First is an HTAO in Katy outside Houston.
This is your textbook passive investment. It's brand new construction with a 15-year NNN lease.
NNN, triple net. Remind us what that means.
It means the tenant, HTO in this case, is responsible for paying the property taxes, the insurance, and all the common area maintenance. The landlord's job is basically to just cash the rent check.
That sounds pretty good.
It is. And the location is prime, right near I-10, with over 35,000 cars driving by every day.
following that model, we've got a MOD Pizza in Rockwall, also a single tenant deal.
Yes, and this one highlights another key detail you have to look for. The lease is corporate-backed.
Not a franchisee.
Correct. That's a huge difference in security. If that specific pizza shop struggles, the corporate parent is still on the hook for the rent. And it's in a great spot in Rockwall, surrounded by traffic drivers like Kroger, Starbucks, and Chick-fil-A.
All right, let's spend a minute on this last one because the list really presents it as the gold standard for passive income. It's an Advance Auto Parts in Odessa.
This really is the most secure investment on the entire list. And it comes down to two words in the lease structure: absolute NNN.
Okay, you have to explain the difference. What makes it absolute NNN versus just regular NNN?
It is contractual perfection for a landlord. A standard triple net lease might still leave the owner responsible for, say, the roof or major structural repairs,
The big ticket items.
the big expensive surprises. With an absolute NNN lease, the landlord has zero obligations. None. The tenant handles the roof, the structure, the parking lot, taxes, insurance, literally everything. It's the purest form of hands-off real estate ownership.
Wow. And what about the tenant themselves? They mention an S&P BB plus rating.
So that's what's considered investment grade style credit. It's technically one notch below true investment grade, but it signals a very stable company with a very low risk of default. This is a national auto parts giant.
And the track record at this specific location.
That's what really seals the deal. This store has been operating here for over 35 years. It's a proven location. And the tenant just signed a fresh 10-year extension. That commitment, plus the 43,000 cars a day driving by, makes this as close to a guaranteed bond as you can get in real estate.
So that gives us a really fantastic snapshot of the diversity in the Texas market. Just to wrap it up, for you, the listener, we've seen EBG point to three core strategies here. You've got your immediate value plays, like that McKinney property selling below assessed value. You've got the flexible value add stuff, like the vacant storage facility or the flex condo. And then you have these super secure, long-term passive income assets.
And this list just perfectly illustrates the huge difference in risk profiles, right?
Yeah.
On one end, you have the absolute certainty of a detail, like an absolute NNN lease with an investment-grade style tenant.
does so.
And on the complete other end of the spectrum, you have a raw piece of land where your entire investment hinges on getting a successful and often very difficult rezoning from the city.
The ultimate high risk, high reward. So, I guess the final question for you to think about is how this shapes your own investment thesis. We saw all those different zoning types in Cedar Hill, SFE, OTRES. How does thinking about a property's future growth path change your definition of best value compared to just looking at today's cap rate? Are you willing to trade a decade of guaranteed cash flow for the potential massive upside of a development project down the road? Something to think about as you plan your 2026 portfolio.